friends, welcome back, and we are back again with IFRS 15. In the previous lectures, we have studied about two steps of IFRS 15, recognizing revenue from customers. That is step 1, identifying the contract with customers, and step 2, determining the performance obligation. Now, in the step 3, we will determine the transaction price of the contract. So, we'll again start with the same thing, why the step has been introduced and what is the implication on the industries, etc., etc. Right? So first understand what does this step says. Step 3, determine the transaction price says the transaction price is the amount which an entity expects to be entitled in exchange for transferring goods and services to a customer. So why this step has been introduced, if we study this step, there are two reasons. Number one, since there is a change in business models, because we have told you in the previous lectures also, the changing business scenarios, there was a need of changing financial accounting standards, right? That's why it has been introduced. And second thing, because of some fraudulent activities. These are the same thing why the step has been introduced. Now, as far as the complex business scenarios are concerned, I will make you understand this concept with the help of an example. Okay, so let's start with an example of a telephone company, because I've told you that telecom sector and real estate are mostly impacted by new IFRS 15. So let's start with telecom. So what happened is, let's say I'm in a hotel industry and I'm um, making a deal with Vodafone, right? To get a competitive price. I'm dealing with Airtel also, I'm dealing with Vodafone, I want to get a competitive price. So what happens when I deal with Vodafone? I ask them, we are giving you 500 numbers because it is a corporate connection. So we are giving you 500 numbers for all our employees. In that case, how much rate will you give us, or how much benefit you can provide us, right? The same question we ask to Airtel also. So they come back with some different kind of proposals, etc. Now, let's say Vodafone comes with a proposal of stating that if our usage minutes in the total bill exceeds 5,000 minutes per month by all the 500 numbers in cumulative, if it exceeds 5,000 minutes, then the calling rate would be say 20 paisa per minute. Otherwise, the calling rate will be 30 paisa per minute, right? So this is a case of a volume discount. Now, what is a volume discount? Volume discount is simple. It's basically giving a discount on the basis of volumes produced or volume given to the company, right? So if we give a volume discount, then in that case, now let us step into the shoe of Vodafone, right? So how they're going to recognize the revenue? Now, if we think about the first criteria, let's say um, we have not reached 5,000 units, 5,000 minutes in a month, then in that case, Vodafone will charge us 30 paisa per minute as per the actual minutes consumed. Let us say 4,000 minutes were consumed. So 4,000 minutes into 30 paisa. This will be the billing. Sorry, this will be the billing, and Vodafone will recognize the revenue according to it into its books of accounts. But there is a concern with the auditors of Vodafone. Now, what is the concern? That in case if there's something, they want to finalize the balance sheet. Let's say on 1st of March we have decided this contract has been agreed upon. So on 31st March they have to not the 1st of March, let's say 15th of March we have agreed upon, and the billing will be generated on the 15th of April, and they want to close the books on 31st March. Let us assume, although it will close after 2-3 months. Let us assume. So in that scenario, they want to analyze, they want to see how much minutes we have consumed, right? If we go through our previous standards, that is IFRS 9 in case of NDS, Indian Accounting Standards, Indian GAAP, if we go by previous accounting standards, what they used to say is the revenue will be recognized as the service has been given or the bills raised, right? So on 31st March, if the bill is not raised, the revenue will not be recognized. It will be recognized in the next period. Or in case if Vodafone wants to recognize the revenue, what they will do, they will recognize it based on 30 paisa amount, right? But giving a volume discount is a kind of variable consideration to the contract. Because of this variable consideration, IFRS 15, in the previous standards, there was no clear-cut clause stating how to deal with such variable consideration. Now, some company can do a different accounting and some company can do something else. In the previous case, Vodafone will recognize revenue based upon its billing. If the bill is generated, they will recognize, otherwise not. But IFRS 15 is very much clear. They say that in case of variable consideration, the amount of variable consideration must be adjusted in the transaction price. That's why the step has been introduced because of these complex models, right? This is called a volume discount. Now let us assume another example. Let us say another example. Um, I'm in hotel industry, so we want to buy hotels for our 400 rooms. Not hotels, sorry. We want to buy TVs for our 400 rooms. Now, for buying those TVs, we approached, say, LG. And we said that we want to buy 400 TVs. What is the common price you can give us? So LG said, okay, if in the current year you have, if you will give us orders of more than 200 TVs in the current year, see, I will tell you why this is I'm saying. In the current year, if you give us order for more than 200 TVs, then the price will be 40,000 rupees. Otherwise, the price will be 50,000. Right? It is called a volume discount. Now, why this is because in a hotel industry, you're not able to buy all the 400 TVs and attach it as it is because it is a running hotel. What I'm talking about, it's not a unopened property. It is a running hotel. So we have to change the TVs or we have to implant the TVs on a step basis, right? 10 rooms at a time, 20 rooms at a time. So it takes a lot of time. So LG says that if you give us order of more than 200 TVs, then you will get a discount of 10,000 rupees per TV. Otherwise, you will get a discount of, you will not get any discount. So this discount is basically retrospective. Similarly, in the previous example also, if you see Vodafone, that discount is also retrospective. It was talking about a full month, right? Or a full year. Basically, these discounts goes till a year, complete year. In a year, if you give them order of a particular amount or particular quantity, then the price will be retrospectively reduced. So in that case, what does the company do? They recognize revenue as per the billing, right? If the order exceeds, they will recognize the balance revenue in that differential period, that differential margin. That's why there is a huge variation in the revenues in one part of the year and in next year, past year and the next year. Because of these complexities, IFRS 15 has introduced this concept of determining the transaction price, that is step 3, what we're going to do. There are other cases also which impact the transaction price, which are written here like significant financing component, non-cash transactions, non-cash considerations, and consideration payable to a customer. We will talk about these also in our upcoming lecture. you about the main reason why the step 3 has been introduced in IFRS. Right? In the next video, we will going to talk about solve an example on volume discount to make you